Hello, everybody, and welcome to the monthly market memo for the month of May 2025. I'm Case Eichenberger, the Chief Investment Officer with Retired Path Advisors. And in today's short video, we wanted to walk through some of the key themes that were moving the markets for the month. And there were quite a few key themes. I'll just start out and say the month of May was up about 6% for the US stock market, which is just a tremendous return for 1 month alone. That's, usually maybe a good year's return, but we got it in 1 month after a really tumultuous April. And this was one of the best months of May over the last 30 years. So if you rewind all the way back 30 or so years ago, this month of May counts as one of the best, up over 6%. There was no short of headlines, though, that kind of caused some choppiness around the markets. And one of those headlines was the key themes was the U.S. government debt was downgraded by Moody's. Now, just to recap, Moody's is one of the three major credit agencies that rates the credit on our bonds. The higher the rating, the less perceived risk. The lower the rating, the more perceived risk there is in that bond market. And you can see all the way back in 2011, S&P was the first to downgrade. Then Fitch came along in 2023, and now Moody's came along in 2025. So nothing too much to make out of this, to be honest. I know you probably saw a lot of headlines and maybe some news across your feeds or in the paper, but this being the last of the three really is so far a non-event. Markets really did shake this off. Now we can go back in history and really look at what happened to stocks when the other previous two downgraded U.S. debt. Did stocks lose money? And we can also look at bond yields. Did bond yields rise sharply when other credit agencies downgraded the U.S. debt? And remember, if bond yields move up, bond prices move down. That's the inverse relationship that's always there. But honestly, stocks and yields, stocks were higher and yields were lower 6 to 12 months later. So really not much to make out of this. If we just look at this, the S&P 500 returns for the other two times this happened before. 3 months it was mixed. Stocks were up in 2011. They were down in 2023. But 6 months later, both higher. 1 year later, both materially higher. So not much to be worried about there in the stock market. The bond market. Again, if yields are falling, that's good for bonds. If yields are rising, that's bad for bonds. Again, kind of a mixed signal 3 months later from now, the last time this happened. But 6 months and 1 year later, both times bond yields are actually lower. So 6 to 12 months later, more of that intermediate term, short term time horizon, we actually don't see a lot of reasons to be panicking about this change in the creditworthiness of the U.S. Government debt. So let's move on to look at a little bit more on the stock market. Now, this was kind of the big thing. Again, stocks are up over 6% for the month of May. What moved that? And a lot of it, again, no surprise, is around tariffs, right? Liberation Day came in April 2nd, early April, where reciprocal tariffs were put on, really on China everywhere, but also China was just moved a lot higher, up to about 145%. And then we got a 90-day pause. This was after they all met in Switzerland there, and we saw a 90-day pause that both sides agreed to in the month of May, which brought that material tariff rate down to about 30% or so on China alone. Now, this doesn't look, we're looking at everything also here in the future. The other big news was a U.S. court did block the Liberation Day tariffs. Now, this is kind of going back and forth as most court battles do, right? So the Court of International Trade came out and said those tariffs are illegal. Really, the power should not have been used that way. The current administration did appeal and got a stay, which meant that the tariffs can stay on for now. So this is something really will be worth watching to see how this moves over time. I think it just adds to a little bit more uncertainty. Now, across the globe, the current trade-weighted tariff rate is about 14%. If these tariffs are indeed illegal, part of them, right? Not all of them, but part of them, the Liberation Day tariffs, those will move down to 5%. So that's a material change lower from 14 to 5%. Still, higher than where we entered the year, but much better. And overall, stock markets did cheer this news, right? The China trade truce and then the potential blockage of some of these tariffs, stocks moved a lot higher in May, and those were the big reasons why. So something that we are watching very closely here at the firm to see how this shakes out over time and what we need to do to potentially be ready for that. Now, some of the major questions we got for the month of May, kind of jumping to this and getting close to the end here. Stocks are up about 20%. That's almost a new bull market from the low, right? We saw basically from mid-April to mid-May, the 27 or so trading days that we looked at, and stocks were up about 20%. Now that's roughly where we're at right now off the current lows. It's just a fantastic move in stock markets. Let's not forget that. That actually ranks as one of the top 15 moves higher in the stock market over the last 50 or so years. Now, let's go back and look to say, is that a good time to actually pull risk off the table, take some profits, sell some stocks, or is there further room to run? We actually believe it's the latter. There is further room to run for the stock market. So keep your risk where it's at. 3 months later, the average is about 8% higher from those other big moves off the low, those other 14 rallies that we saw throughout history. Now the low was minus 11%, so you do get some choppiness there. But 6 months later, the average is 22%. 1 year later, again, more of that short-term to intermediate-term time horizon, the average is 41%, and the low is 25%. So again, big moves like this are no reason to sell out of stocks. It's actually, maybe a further indication that this is a new bull market that we're ready to have take shape here. And then, of course, 5 years later, this is cumulative. The average is 140%. So, this is the good volatility you see in stocks over time. So we would say that no, do not take profits. Of course, talk to your financial advisor, and there may be a different scenario that you're having happen in your household. But if all else equal, just stay invested to where you're at. And then finally, I'll close it out and talk about the tax bill. This does have market implications, of course. The tax bill did pass the House of Representatives. We're showing here how this kind of affects the deficit, right? Typically, we see this being a bit more stimulative to the economy in the near term, which is good, can be good for stocks. I think that's part of the move higher we saw in May. And then the cuts do kick in later and actually can offset a lot of those stimulative measures of tax changes for the better. So we look at this and kind of highlighting here on the top left, larger deficits in the short term, right? Tax cuts, no tips on overtime, no tips no taxes on tips and no taxes on overtime in the short term. And then longer term, we see a little bit smaller deficits as some of those cuts to Medicaid and other provisions kick in. Now, we will say that this is just passing the House. Next, it will go to the Senate, and definitely expect some revisions. Probably see some of those things dialed back. We'll have to update this chart again. But so far, not a big potential increase in deficits, to be honest with you. This kicks in later with all those cuts. So something we'll continue to watch, how this affects stocks, bonds, the US dollar, and everything. So with that, thank you for watching the video. We approach the management of your complete financial landscape very seriously. As a trusted steward, advocate, and confidant, we're completely committed to you, the client, at Retire Path Advisors. You can always email us with any questions, give me a call, give your financial advisor a call with any questions. I would encourage you to visit our website. We have a lot of great blog materials out there around retirement and around the markets that I write that you can definitely try to stay on top of these things in between these monthly videos. So thanks again for watching, and we will talk to you next month as we enter more of the summer weather. Thanks again.